Hello and welcome to the look ahead for the week starting the 26th of May with me, Fiona Cincotta, Senior Market Analyst at City Index. So as always, I am just going to ask you to start by taking a look at the risk warning. I'll just leave this up here for a couple of moments whilst you read through it. Okay, so let's kick off then. So just to start with, have a quick recap of the previous week, what's been going on. We've actually seen the US equities fall across the week amid rising concerns over the debt pile in the US. Now, at the start of the week, we had Moody's downgrade the US sovereign credit rating, making them the third credit agency to do so, rating agency to do so. And that came at a time where we also saw Trump's bill, the big beautiful bill as he calls it, voted through the House. Now it still needs to face the Senate, but this bill is particularly important because it contains sweeping tax cuts, which could add significantly to the US debt pile, which there are reports that it could add an additional 3 to 5 trillion to the US debt pile, which is already at 36 trillion. Now, this is getting the market a little bit nervous. So as a result, we've seen really that sell America trade taking place again this week. US equities sold off, the US dollar has also fallen, and US treasuries are also sharply lower as the markets look for alternatives, particularly from the US treasuries. The long-dated 30-year treasury, the yield has pushed up above 5% and still remains there today. Yields rise when investors sell out of bonds. So there are some concerns there. Obviously, we're seeing investors look for alternative locations for their money and their funds. And so, yeah, as I said, we saw the recovery here. This has been the recovery that we've seen down from the 4,800 level, ran into resistance just below the 6,000 level. Now we've fallen back to here, which is the 5850 level, 5850, 5800. That's also the 200 SMA. So that bearish engulfing candle is a little bit ominous. The uptrend, I would say, is still intact for now, but it does seem to be sort of at a key support area. If we take out this level here around the 5800 and the 5850, and also obviously the 200 SMA, then that could look to a rather, we could see sellers gain momentum. Now, what are they going to be watching out for? Well, let's just have a look. There isn't actually that much going on as far as the US is concerned next week. We've got Federal Reserve Chair Jerome Powell, who's speaking on Sunday evening. And then there's the FOMC minutes also to think about. You've got GDP, but it's not a preliminary reading. So it doesn't tend to be as market moving. And then core PCE, which is the Fed's preferred gauge for inflation. So quite a bit actually going on as far as the US dollar is concerned towards the second half of the week. Obviously, keep in mind on Monday, there is a bank holiday in the US as well. So any impact from Federal Reserve Chair Jerome Powell's speech will be seen more in the US dollar, obviously, as stock markets will remain closed on Monday. But what can we be expecting? Well, I think so far as the main focus as far as data is concerned will be on that US core PCE, which is which has so far proved to be fairly good news as far as the market's concerned. We saw core PCE ease back to 2.6% year on year in March. That was in line with expectations, but spending actually remained resilient. We saw personal income rise 0.5%. and spending jumped 0.7%, which was ahead of expectations of 0.6%. So, I mean, all in all, that data pointed to solid consumption, easing inflation, all of which was good news as far as inflationary, as far as the Fed is concerned. However, you know, we all sort of took that data knowing that things could potentially change as the impact of Trump's trade tariffs start to ease through, potentially adding to inflation. Also, will consumption take a hit as consumer sentiment deteriorates? So as I said, so far the numbers have held up pretty well, and the market will be watching closely to see whether this impact is going to start showing through. So if we do have any signs of hotter than expected inflation, weaker than expected consumption, I think that could be a warning or sound alarm bells, at least in the market. That could bring US stocks lower and potentially feed into safe haven demand. Let's just have a look at what the gold is doing, because gold has recovered actually fairly strongly from that low of 31.20 that we saw in mid-May. So we saw this sort of like attempted breakdown, a failed break, and then we saw the recovery. It has recovered pretty well back up to, I think it's above 3,300 there. 33.25 is where it is at the moment. Now, it is interestingly just testing that falling trend line that dates back to the all-time high. So it'll be interesting to see whether we can get a break above that. Obviously, these concerns surrounding the debt in the US, combined with this sort of ongoing uncertainty surrounding trade, means that the gold demand or safe haven demand has picked up once again. Also, the gold is benefiting from weakness in the US dollar, which has fallen quite sharply again this week after several weeks of recovery. Let's just pull up the US dollar and just take a look there. You see, we saw several weeks of recovery. Now we've seen it fall again, back down below that 100 level, key psychological level, trading at its lowest level in almost 3 weeks, but definitely in 2. If we continue to see further weakness in the US dollar because we get weaker than expected data, watch out for this level here. This is the 99, oh, bear with me, the 99 level, and then below here we've got the low for the year, which was down at 97.92. So sellers are going to need to break below there to get a lower low, but also this is 99.15 level. That's also one to be watching. RSI is below 50. So do you know what, with the right catalysts, this could be, we could see further US dollar weakness. So that's core PC and GDP. I mean, the GDP data, as we said, we knew it was 0.3%. That was a preliminary reading that we found, and actually that weakness was actually to do a lot more with importing ahead of Trump trade tariffs, rather than because there was actually a sort of fundamental turn down in consumption and the service sector, so which is the dominant sector in the US economy. The other thing to keep in mind is we've got the FOMC minutes. Now, these are going to be pretty stale given that Jerome Powell will have spoken on Sunday. So they may not be particularly market moving. We also, as I said, Jerome Powell is speaking on Sunday, and he any comments that he makes towards the outlook for the Federal Reserve will obviously be extremely closely watched. Now, the Fed, we know, have not cut interest rates so far this year amid concerns over the impact that Trump's trade tariffs will have on the economy. So very much in that wait and see mood, waiting to see what the economic impact of the tariffs will be. As I said, as that hasn't been showing through in the hard data yet, I mean, even if we just look at PMI figures for yesterday, they came in stronger than expected. So, you know, there's nothing that's necessarily causing concern for the Fed. Jobless claims as well are holding up. US labor market hasn't shown any worrying signs yet. But the Fed said they stand ready to cut rates. They're expected to cut rates once this year, but actually the reality is, you know, there are some Fed presidents, Fed speakers who have suggested that maybe they won't even do that this year. Interestingly, though, that's not really offering too much support to the US dollar right now, which, as I pointed out, is trading considerably lower against its major peers. So what else will we be watching out for? We've got, as far as speeches are concerned, government Ueda, Bank of Japan governor, will be speaking. Now, interestingly, his comments will come at a time where the yen has strengthened quite considerably. We've recently seen stronger than expected, or just overnight, in fact, we saw a rise in core Japanese inflation. We also have Tokyo inflation data next week, which tends to be considered a lead indicator for national CPI. And so there is this sense that inflation is rising in Japan, which is supporting the view that the BOJ will be cutting interest rates again later this year. Now that's helping the yen strengthen. Obviously, we've also got some safe haven gains in there amid the mess in the US dollar and the sell America trade. And so, yeah, so if we do see sort of hotter than expected inflation, then we could find that that actually boosts the yen further. Levels to be looking out for, and persistent US dollar weakness as well could also drag on this pair. Just testing really quite an important level at the moment, that 143.50 level. It's a level that's sort of been important over the past 2 months. If we do get a break below here, then we'll be looking to take out this the falling trend line resist support. That's the upper band of this falling channel, which has been in play since the start of the year. If we get a break below that, then we'll obviously then be looking towards that 140 level. Should we find that buyers defend this level on the upside, watch out for 145, 146.15. They're the levels to be watching for on the upside. Okay, so what else have we got going on? Yeah, so any hawkish comments from Ueda sort of pointing towards that, a potential BOJ hike could help lift the yen further. We'll come back to the RBNZ shortly. We've done Tokyo inflation. Okay, Germany. So as far as Germany is concerned, we've got retail sales. We've also got inflation figures. Inflation in Germany, let's just pull up the DAX, because the DAX has had a strong ride, trading at all-time highs, really. So let's have a look. The DAX, the German CPI it eased to 2.1% year-on-year in April, marking its lowest level since October 2024. We've also seen that producer prices, which measure inflation at factory gate, fell by the most in 5 years to 0.5%. Elsewhere, also Germany's PMI figures were, which were released last week, were considered considered a lead indicator, fell by the most in 5 years. German PMI figures last week, showed that the business activity, well, actually it's this week, it's yesterday, when I'm recording, but basically, the PMI data show that business activity contracted in May amid a sort of slump in services. Basically was weaker than expected. Now, this supports the view that ECB policymakers, will continue cutting interest rates. They're expected to cut rates by 25 basis points in June and potentially again towards the end of the year. Now, these expectations that the ECB will continue cutting rates has helped lift the DAX to record highs. It also has helped what's also helped here is that asset relocation away from the US, looking for alternatives. We've also got the political stability in Germany after the Chancellor was elected. And so the outlook for Germany, despite the actual sort of fundamental economic outlook being weak, the prospect of further rate cuts and a supportive government has helped the DAX rise to record highs. If we get above this 24,000, we get a good close above that 24,000, then that could open the door 24,500. Down on the support, we've got 23,500 would be a level to be watching out for. Just going to have a quick look at the euro US dollar as well. Euro is benefiting from US dollar weakness as sort of the most liquid alternative. It's not that the economic outlook for the euro is particularly strong, but it's definitely been benefiting from that US dollar weakness. So we've seen a recovery from the low that we saw back in May of 110.65. Series of higher highs and higher lows up above the 112.80 level. Now we're looking towards the 114 level. That's where the buyers are going to be looking to aim towards in order to then bring that 51.15 level back into focus. If we get weaker than expected data from Germany, that could limit the upside in this pair, particularly if we see any sign of inflation starting to build in the US. So yeah, just on the downside there, also the levels to watch. That just watch also this 50 SMA, because that appears to be what has been guiding the price higher. So just having a look here now at New Zealand dollar ahead of the RBNZ rate decision. The central bank is expected to cut rates by 25 basis points to 3.25% in the May meeting, and could also indicate for appetite for further easing. Obviously being data dependent and depending on how the global growth environment is impacts the New Zealand economy. Now, interestingly, the economy has been beginning to respond to lower interest rates. The recovery remains slow and uneven, but however, there are sort of, the RBNZ has created a new report looking at inflation expectations, which were actually rising across all horizons and could be at odds with the central bank's rate cutting stance. Now, if we do find that, I think that obviously the US dollar is going to be quite dominant here as well, but if we do find a slightly more hawkish stance to the RBNZ, then we could find that the this Kiwi US dollar rises up towards that 60.35 level that we last saw in April. That's actually the 2025 high. On the downside, we've got support here at 0.5880. That's the 200 SMA. And then below that, we've got this level here, which is the 58.45 level. Which if we get a break below there, and that was if we get sort of concerns by the RBNZ over the impact or slowing down of the global economy on the New Zealand economy, that would be what to be watching out for on the downside. That level's also the 50 SMA. So then I think just finally, well, let's take a quick look at oil, because oil has been struggling this week. Obviously, there are these concerns about the demand outlook as far as China is concerned, as far as the US is concerned. But there have also been reports that OPEC Plus could be looking to increase its output further when they meet on June the 1st. So that's sort of something else which has been dragging on the oil price. It seems that OPEC Plus is really actually becoming quite keen on playing for market share rather than keeping the price elevated. And that sort of change of stance means that we're seeing this price come under pressure. There was a failure to break above that level here, 63 earlier in the week, and I mean that was just a spike, but the price has come down quite considerably since then, trading above the 60 level. If we get a break below that, that could be quite significant. We could see a fallback towards the 55 2025 lows. On the upside, definitely need to rise above that sort of 63.80 level, 64 level, in order to bring 65.30 into focus. And then finally, the other one to be watching is the Nvidia. I'm just going to bring up, first of all, the US, the Nasdaq of in a similar position to the S&P 500. We've seen that recovery, but that recovery has stalled. Now, it'll be interesting with Nvidia reporting, will it be able to bring some attention back to the AI trade, which really has died a bit of a death since Trump has come to power, and the focus has been very much on trade, tariffs, now debt concerns. So, you know, will this be able to revive some AI optimism? Remains to be seen. Expectations are for, it reports after the close, by the way, on the 28th. Expectations are for EPS to be 0.88 cents on revenue of $43.26 billion US. Now, the firm has beaten both EPS and revenue forecasts over the past 4 straight quarters. However, we did hear CEO Jensen Huang say recently, just this week in fact, that there were some concerns that the US policy to limit shipments to China has actually worked against them, in the sense that there has been much more local development and use of local chip makers in order to, it's almost boosting the competition in China, which Nvidia CEO highlighted as being a negative. So it'll be very interesting to see what's being said about these restrictions when after the earnings call. So this is, yeah, as I said, the Nasdaq. We've risen to a high there of 21,500. Near-term support is really interesting. It's here. It's that 20,250, which is the 200 SMA, as well as this sort of horizontal demand as well. We haven't seen any concrete signs of reversal. Okay, so we've just seen a pullback from the all-time high, which does technically mean that the uptrend is still intact. In which case buyers will be looking for a rise above 21,500, looking towards 22,250 to fresh all-time highs. On the downside, yeah, as I mentioned, the support there at 20,000, 350, 250, which is the 200 SMA. And let's take a quick look at Nvidia. Okay, so it has recovered from the low that we saw in April 2025 low, recovered up to this level here, haven't made it up to the 140 yet, which was the February high, but we are above the 200 SMA, which is a good sign, just having a period of consolidation, which could continue up until the earnings release. On the upside, 142.75, that was the high that we saw back in February, and that could then potentially open the door to the 152 level, and fresh all-time highs. Disappointing numbers, disappointing outlook could bring the 200 SMA at 125 into focus. So I hope that you've liked everything that we've been through. If you do, then please do give this video a like, and for more videos like this, I'll see you next week.